Hi everyone, this is Baggett on StockMarketCaddy.com, and I wanted to do something that we don't do all the time, and I wanted to take a comparative look at the S&P versus gold. It is June 8th at 8:30. Peter Schiff was on the Fast Money Clowns, and that arrogant dude was giving him a whole lot of crap. We're big fans of Peter Schiff. I think on balance he's been right more often than not, and maybe off with his timing, but timing is always an art form. But I wanted to offer up a perspective, and again, what we do day in and day out, this doesn't have a whole lot to do. We have strategies that run on comparative basis intraday. We get in, scalp, do what we got to do for a couple of days, trade, make money, and move on. We're not economists, but it's not every day that we're looking at a monthly chart. So I want to look at the monthly chart on the S&P and gold at the same time. There's a lot of information here to take in. I'm not going to make too many conclusions here and let you draw your own. Okay, so let's get started. The green line is the monthly line of the S&P. This is the crash in '09. The gold line is gold. Okay, so I've had to mark this up in the interest of saving time. I'd like to get this video in and out to everybody under 10 minutes so it can go up on the YouTube. Before the crash in '09, this ratio here of 1 to 1 meant that 1 ounce of gold, if you owned 1 ounce of gold when it was valued at roughly $780, you could buy 1 share of the S&P. Then we crash, and they diverge. Gold goes up on a fair trade, and then gold continues to go up, probably still lingering fair. And then gold really went parabolic, if you recall, in 2011, peaked out in around the August time frame of 2011. And this is when there was tremendous inflation fear and misunderstanding, or maybe understanding, if they had their timing wrong, that all this QE was going to lead to inflation. At that time, at the peak, 1 ounce of gold at its high would have bought 1.66 shares of the S&P corresponding at its high, 1.66. Then gold begins to correct. Maybe the realization set in, dollar got a little bit stronger. Maybe everyone thought, I'm not going to speculate on that. The next time that gold would buy 1 ounce of gold would buy 1 share of the S&P was back in 2013 at almost exactly 1,500. So it's interesting, we were at 780 and almost 1,500. At that point on a monthly basis, gold continues to correct, making lower lows and lower highs on a monthly basis. Now this is back in the winter time, December, November of right here. At this low and at this high of the S&P, if one wanted to buy the S&P with gold, which we think is real money, can't shave it, can't make it, can't produce it, can't really manipulate it all that well. Either you have it or you don't. And it would take 0.52 ounces of gold at this low to buy 1 share of the S&P. In relative terms to gold, I would say that this represented the most expensive point of the S&P. Okay, right in here. Compared to back here, certainly compared to here. Today, gold has resumed an uptrend. On a monthly basis, she's making higher lows than here, and a higher high. Still on the verge of breaking out. Based on where the high of the S&P is at 2109, it would take 0.66 ounces to buy 1 share. Still very expensive to back here, almost 40% more expensive. Certainly much more expensive than here. And once again, even from here, 40% more expensive. Now, I'm not projecting anything and not saying anything about where the S&P goes. Things can get even more expensive. But gold, the person who has the gold is saying, hey, if I'm going to buy this S&P based on where I am, then I need to get more shares for my gold. It's very, very clear. And we're not looking at the dollar, we're not looking at oil, we're not looking at aluminum. You can do this for anything. Those other markets, though, very easy to manipulate. The gold, the dollar, of course, easily manipulated. Gold, aluminum, hide it in boats, hide it in warehouses. Now, the other thing that I wanted to share with you, so I find these ratios very, very relevant in terms of the valuation of the S&P. The other thing that I wanted to show you is that we're already drawn in, and I invite you to do this. If you're looking at the S&P on a monthly basis, we drew a Fibonacci extension. I drew it from the low. I really was conservative. I didn't draw it from here. I made this the A point, this the B point, and then we get a Fibonacci extension. Most Fibonacci extensions for stocks will generally be around 100%. Extreme extension in valuation would be a 1.61 extension. That extension on a monthly basis would have brought the S&P to 2091.19, and we hit our head on that number for all these months. All these months. This is monthly. This month we are poking our head over 2109. We want to see where this thing closes this month. If we reject this level, we'll in all likelihood be making our way back. We are of a mindset that this trend has already broken and that we made a lower low, we made a lower high, and we're on the verge, but we made a lower low. Others would say, nope, we're starting a new trend because we've made a higher low and we're making a higher high. If that's the case, and if we are making a new extension from here, and this was the extent of our correction, if you do a Fibonacci in here, which I've done, so we go from A to B to C, and then if we did a full 1.61 extension from here, it would be 2194, and I would suggest to you that that is the absolute outside chance for the S&P. The 100% extension of this little correction, and you have to zero in on this video to see it, but I'm going to read it to you, is 2087.61, which is actually less than here, which confirms our view that this is a correction in a downtrend, and it's more important to be thinking in terms of pulling back. So we think that the S&P is oscillating up here and is on the verge of pulling back for a couple of reasons. One, in terms of valuation, in terms of extension, she is fully priced, fully extended, and I think we're going to see that the buyers are exhausting themselves. The other part is that inflation appears to be kicking in, and the folks holding the gold are not going to pay these higher prices. And the inflationary environment here, whether it manifests itself in gold or in oil or in other commodities, is going to act as a governor on the overall market. Now, whatever Yellen does or doesn't do, she may let this inflation run a little bit, but she's not going to want to let it get out of hand, and she doesn't want to get behind the curve. Because you may see with gold it running $50 a day, or oil running, if she's behind the curve. And the only thing that she can do, we'd be in an environment where we have inflation with little to no growth, and that's stagflation. And the only thing she could do would be to raise interest rates now in the face of a slowing economy, in the face of inflation, and it would be a Volcker moment. So we see the S&P correcting on a time cycle. It's interesting. We drew a time cycle from when gold was at par and then at its peak, and a lot seems to happen in the July-August time frame with gold, both peaking and correcting. So we think that these next few months here are going to be key. So we are long gold. We are shorting the overall markets, and we just invite you to give it a thought, do your own comparisons, let us know. And also, Elliott, there's a lot here. Elliott wave people on a monthly. Count with me. 1, 2, 3, 4, 5. 5 waves on a monthly. Folks, these markets are topping out. The rest of what you're hearing about going to 2,500, just like gold. They're saying that that markets can't top out making new highs. Well, look at gold up here, folks. That was the top. It made a new high. There are tops. It's not how we make our money day in and day out. We trade ranges. But you need to be aware if you've got your 401k money in these markets. Get some insurance on. Good luck.